Dr. A. Gary Shilling is president of A. Gary Shilling and Company, and pleased to have him back on the program. Dr. Shilling has been a Forbes columnist for many years. He has a stellar forecasting record. In the spring of 1969, he was among the few who correctly saw that a recession would start that year. In 1973, he stood almost alone in forecasting the world was entering a massive inventory building spree to be followed by the first major worldwide recession since the 1930s. He has a book, the most recent book that he's written, one out of many, I should say, is The Age of Deleveraging, Investment Strategies for a Decade of Slow Growth and Deflation. And Dr. Shilling, welcome back to the program.
Delighted to be back with you.
Well, let me just jump in, because in your most recent Insight newsletter, you discussed the effectiveness of the Federal Reserve's quantitative easing policies. You discussed the fact that this policy has been pursued for many years in Japan with no noticeable long-term success, but the Fed has pursued the action anyway as if a similar action will produce a different result, and that was my observation. Dr. Shilling, has the Fed just run out of every other option?
Well, they really have, and it isn't to say that what they've done has had no effect. You never know what would have happened otherwise, but it certainly hasn't returned the economy to rapid growth, and neither has all the fiscal stimulus, the tax cuts and spending by the federal government. And I think what it tells you is the extent to which this deleveraging in the private sector in this country, around the world, is swamping, offsetting all this monetary and fiscal stimuli. It really is a massive event, and it's probably going to continue for another 5 years. That would make the usual 10 years that this deleveraging tends to run after big financial crises.
You know, your book, Gary, The Age of Deleveraging, Investment Strategies for a Decade of Slow Growth and Deflation, I think that may run contrary to what a lot of our listeners are actually visualizing as an ultimate potential economic outcome. With this printing of money or easing, I think the big fear a lot of folks have is inflation. So how do you square that in the minds of some of our listeners?
Well, the fascinating thing is that with all this monetary and fiscal stimuli we've had, there's virtually no inflation in the world. As a matter of fact, there's a lot of deflation. Real wages are declining. We've had about a third decline in house prices in this country. Commodities prices generally have been declining since early 2011. I mean, there's really a lot of deflation, and again, it tells you how much excess capacity, excess labor, and so on there is in the world. Now, of course, the question is, sure, the Federal Reserve, other central banks have pumped out all this liquidity. How do they get rid of it? Because the economy eventually will get through this deleveraging. I think it's probably got another 4 or 5 years to run, as I mentioned earlier, but then you resume normal growth, and there is the withdrawal, the re-entry kind of issue, and that is up for grabs. The central banks of the world, they're grappling with this. How do they get rid of all these securities that they own? How do they avoid this turning into excess money and ultimately inflation? But right now, the banks are not turning much of it into money. They're just sitting on a pile of excess reserves, and that problem may be there, but it's down the road a number of years.
Gary, when I hear you say deflation, that is synonymous in my mind with economic contraction. Can you give us your forecast for the U.S. economy moving ahead?
Well, deflation is not necessarily the result of a weak economy. It was in the 1930s. There are two types of deflation. Deflation means you got more supply than demand, and you can get there by either demand declining, as it did in the 1930s with the Great Depression, or with supply increasing. And that's what happened in the later half of the 19th century when we had new, very productivity-enhancing technologies. One of them was the American Industrial Revolution in full flower, and the other was the railroads, which opened up the whole country. The 1920s, roaring 20s, were deflationary because of excess supply. Two new technologies, mass-produced cars and electrification of homes and factories, which brought with it appliances, radio, and so on. I think you've probably got a little bit of both right now. But as far as the outlook right now, my forecast has been really since I wrote that book a couple of years ago, The Age of Deleveraging, that we'd have 2% real GDP growth per year while this deleveraging continues, and that's about what we've run, and I think that's about where we are. The risk is on the downside, recession. We're long overdue for one, but I think it's going to be slogging through slow growth at best.
Gary, give me your opinion on government policy and the effect that it has on maybe the country actually going into a recession versus not going into a recession. And I'm referring, of course, to the recent discussion about the sequester and all the bad things that were going to happen if the sequester cuts were allowed to take place.
The problem is that the inherent economic growth now is so low that it doesn't take much to push you into negative territory, and that's what recessions are all about. The Congressional Budget Office, nonpartisan body, estimates that the increase in the payroll tax, which took place at the beginning of the year from 4.2% to 6.2% back to where it was earlier, that'll take about 0.6% off of real GDP growth, and the sequestering will take another 1.5%. Now you put those together, and that would probably put you into recession unless there were a lot more growth out there than I thought. So those are serious issues. And then, of course, you don't know what's going to happen beyond that. March 27th, the government will run out of money unless Congress extends the funding. They probably will. And then you've got the debt limit coming up, and there's gridlock in Washington now. They're fighting it out. I would suggest that this is probably going to continue to be gridlock unless the stock market takes a tumble. The one thing that gets the attention of everybody in Washington, regardless of party, is a big nosedive in stocks. And it may take that, because right now there's nothing in Wall Street that tells them that the sequestering or the increase in the payroll tax is any big deal.
Well, we are chatting with Dr. Gary Shilling, president of A. Gary Shilling and Company. His newsletter, Insight, is on my must-reading list every month. If you'd like more information about Dr. Shilling's newsletter, you can call 1-888-346-7444. The number, once again, is 888-346-7444. And Dr. Shilling, we have about a minute and a half or so left in this segment. Many of the world's central banks are pursuing easing or money printing, and it seems like there is a worldwide currency devaluation going on. How does this affect worldwide trade?
Well, there is. There are devaluations. Countries have been very frustrated. Monetary and fiscal ease hasn't returned to rapid growth, so they all want exports. The question is, export to whom? And so what they're resorting to is reducing the value of their currencies. You can do that either by cutting wages, cutting taxes, making your exports cheaper, or you can do it by explicitly devaluing the currency, and that's what Japan is doing now. And it does disrupt trade. Of course, there's retaliation. Nobody wins. Everybody will probably devalue ultimately against the dollar, the world's major currency. But it does disrupt trade in the meanwhile. It's one of the factors that obviously is very, very much on the downside.
Well, we are chatting, as I said, with Dr. Gary Shilling. We will continue our conversation with him in the next segment when Everything Financial Radio returns. Stay with us.